Joining us now to discuss is Jeana Curro, head of agency MBS Research at Bank of America Global Research, and John Lovallo, senior home building analyst at UBS. Good to have you both here. Jeana, love to start kind of from a top-down view through the lens of mortgage finance. We've seen a pretty steep retrenchment in just the number of new home sales, the amount of housing turnover, and now we're seeing a bit of a price response. Affordability became very challenging. Does this mean we're in for another down leg in housing, or are there signs of some kind of stability or equilibrium emerging here?
Yeah, so thank you. Great question. The rise in mortgage rates that we've seen year to date has just had such a strong impact. And if you think about what that's done, it's really, it's essentially raised the average mortgage payment about $500. We are now seeing that. First, you saw it in the home sales declines, which are down about 6 consecutive months. And only until recently have you started to see it in price action. So, it feels like price action is lagging a little bit. But, we think we're on track to see home prices up 10 to 15% this year and potentially up, maybe 2 to 5% next year.
And what's going to drive that push higher in prices more broadly? I mean, is it still the old, demographic story, the supply-demand being favorable, or you think mortgage rates are going to come down in order to make them more affordable at higher prices?
Yeah, a little of both. I think we still are generally light in inventory. So sure, inventory is increasing, but the way we see inventory increasing is really we look at month supply as a fraction of what home sales are doing. So when home sales are on a slower pace, what that means is there's more supply in the market. It's not that you're necessarily seeing all these extra units hit the market. And then also, we think that it's possible to see, to end the year around a 4.25% mortgage rate, and that should help somewhat.
Yeah, that would obviously be a good deal off the recent highs. John, you've been pretty upbeat about the prospects for some of the home builders. We've gotten Toll Brothers results in the last 24 hours or so. How does that fit into your view? I mean, the stocks still remain under some pressure, well off their highs, though not really declining too much on the latest fresh batch of data.
Hey, Mike, thanks for having me. Yeah, I mean, I think I would agree with your points and also what Jeana was saying. Look, I think that the data has been bad, and by definition, the data has to be bad in order to form a bottom, which is exactly what we think is happening. Now, what was the most interesting takeaway from the Toll Brothers call was that they said that August was actually seasonally better than it should have been, right? It was actually up 25% for their non-binding contracts versus July. So, look, I mean, I'm not saying that we're out of the woods yet, but it does feel like we're starting to form some kind of base here. Now, that's pretty consistent with our own channel checks, the most recent of which was in the Carolinas, which the brokers that we spoke with on the ground were pleasantly surprised with what they saw in August. But more importantly, the buyer traffic that's coming in now seems to be more qualified, more engaged, and they believe it sets the stage for some kind of recovery in September. We'll see to the extent that that happens, but the bottom line is that things aren't quite as bad, as the market initially anticipated, in our view.